Hi guys, I hope you guys are good. I hope you guys are very good. So, continuing our series. This is part three of our 1 to 5 pattern recognition series. So, on our previous videos, we had Euro USD and we had gold analysis. As you can see, the difference between the previous analysis and now is that after 1 a.m., price created relative highs and lows immediately right after. So in this case here that we have, I wanted to have this kind of price action during this process, and luckily I did have it. So as you can see, we have this 1 hour candle. Now that the things are different now. Price started trading lower and then it went higher. As you can see here, you would have thought that these are the relative highs and lows, which are not because price didn't take out one side to attack the other. So price created displacement low, then it consolidated here, leaving out the true open as I showed you in the previous video, and then it gave us a fair value gap here, but it didn't take out the sell side before it went up. So if the price did take out the sell side, I was going to be convinced that the price this is a model that we're supposed to trade as we're going higher. So price traded lower, created this consolidation, then went higher. Then now that's when the price creates relative equal highs, relative equal lows. So this is where the magic happens. So what I'm trying to say is that it doesn't matter if the price is over 1 a.m. You don't do anything until you see the relative equal highs and lows that are really accurate and that in confluence with your model. Because right here, as I told you in a previous video, you can just go back and check it out. We have the midnight opening, which is 00 GMT to 00:30. So this 30 minutes interval is where price creates consolidation and it gives you a bias on where price is likely to go. So here, as I'm measuring the highs and the low between 00 hours to 00:30, the second standard deviation is right here. And what do we have above it? We have the 1 minute fair value gap right here. As I told you before about the deviations, they are not used to reverse price, but they are used as a measurement tool to where price is likely to go. But what you need to do, what you need to have, you need to have a PD array above that supports that deviation, or a fair value gap below that supports that deviation. So right here, measuring this midnight opening, I'm going to make a lesson about the midnight opening, by the way. So this is the fair value gap that supports midnight opening. As you can see, the price. Let me just remove this fib here. The price started consolidating right about here. Then it went up and took out the buy side liquidity, which is where you can take your first entry here. So also what I wanted to show you in this different price action video is that the price took out this buy side liquidity. There was no true open here. Normally in our videos, I told you that we buy or sell below or above a true open. So in this case, we are targeting a true open. So now we're using a true open for exits. In our previous videos, we're using the true open to enter the trade, but now we are using the true open to exit the trade. As you can see, this is one daily true open. Um, this is where the initial target was. And what do we have below a true open? We have a fair value gap below a true open. So this is where you have taken the sell and targeted the true open. And well, regarding this consolidation, to find where the price is likely to go, you just have to measure deviations. In this case, I was using a Fibonacci extension, which you can measure from this high here to this low and drag it back. So this is the second standard deviation, that where the price I was looking for when you were selling and wanting to find your exit. So you see this deviation give you a good direction of where the price is likely to go without you trying to hold a long trade, whereas the trade is just it's just a few minutes pip, because that's like a whole lot of pips from here to here. That's a whole lot of ticks, because now I'm using US 100. So the same model, I've used it over and over. As I showed you before on gold, I showed you before on euro. Now I'm showing you on stocks, which is a different asset class, but the directive is still the same time, same model, same price action, where the price consolidates and trade higher and then trade lower. So one thing I want you to understand properly is that the price, you don't have to choose any relative equal highs or relative equal lows. You need to wait until you find the relative highs and lows that meets your criteria. Because at this point, some people have still thought this is a relative highs and lows. No, we just have to wait and find the most logic PDR raise using the midnight open. If it's the 7 a.m. candle, maybe let's say 7 a.m., because this one is 1 a.m. Example Friday 7 Feb. So if you want to use the 7 a.m., you have to use the 6 a.m. to 6:30 opening of New York opening. So you can use that range to measure the same deviation, and you can use this on 00 GMT to 00:30 to measure the 1 a.m. model. As you can see, also when we look for the target, I do use the same measurement from this low, from this high to this low here. And you can see here, here's a second standard deviation, and that's where the target went down to. So now you can see that you can find the, using this only range here, you can find where the price is going to manipulate to, and you can find where the price is willing to distribute to. So this is the lesson three. It's part three of the pattern recognition series. Same model, same everything, same price action, different day, different pairs, different asset class. So this is oh, I just made a mistake here. So this is the ambition submission 711. I didn't write my invitation before. 711 model 2024. So this is part three, uh, analyzing the NQ. So I just want you, so the difference between the videos that I've sent you before and this one that I have now is that the price when around 7 a.m. it didn't consolidate at the same time. But let me show you the difference between these two. So right here in our previous lesson on euro and gold, the price did this, um, and took out the buy side, then traded lower, then reversed to a true open, and then it traded to the deviation. So which the price, maybe the price was 1 a.m. here, and immediately the price created relative highs and relative lows and took out the buy side to the sell side and retraced to a true open here and a fair value gap here. Then the price traded lower to a second standard deviation. So in this case, things were different. Let me just remove this. In this case, things wasn't that as simple as this power three here. Price started and created a displacement low and a displacement high. So in this case, this is where you wait. You wait for the model. This is where you're getting tricked. This is the part that you need to understand, because you know that some people are going to be looking for this model here every day, but we cannot going to have something like this some of the time. So this, when the price does this, you need to wait until the price gets to create those relative equal highs. Using these measurements here, you can find where the price is likely to go for manipulation and the distribution. So I hope you find this one insightful, and I really hope that you understand. If you want more of these, just hit the subscribe button. I'm going to be sharing the Fibonacci settings that I use. I'm going to be sharing a lot of gems, a lot of examples. It's better to find a model that repeats every day than trying to try to win the trading, not even knowing where the bias is, where what to look for, what time is supposed to be on a chart, end up being a chart the whole day. So it's better to find a specific model that you can be able to work on, and having an uh, opening time where you know that this is the time you go to your charts, this is the time where you analyze the market, and you know what you're looking for while you're analyzing the market. So the 7 a.m. model can be like this. Straight after 7 a.m., 1 a.m., the price can just consolidate, go high, and take out the sell side, prepare to trace back to 50%. This is OTE, by the way, and the price can get lower. Or the price can just start by decreasing displacement, then it consolidates, take out the liquidity, then to the second standard deviation. So just hit the subscribe button. Then I'm gonna be making live trades, live executions, live lessons. So yeah, I hope you guys find this one insightful. I'll see you on Monday when I make my Bitcoin US30 analysis, which is part four of this pattern recognition series. Then the part five, I'll be wrapping up the Bitcoin. So I think I'll be ending this sessions on Tuesday, I think. So yeah, I hope you find this one insightful. Till we talk again in our next video. Cheers.